Now to Cameron Peacock. He joins us from RG Markets in Melbourne for a bit of a take on the market's performance. Cam, good morning to you. The market doing okay, fairly lacklustre leads. Should make for a somewhat of a subdued close to trading today. But we're seeing sort of some stocks jump around, some of those big heavyweights. So how are you seeing that index being influenced there today?
Yeah, good morning, Moira. Obviously, US markets, rebounded off their lows last night, finished fairly flat. I said to a few people I spoke to this morning, with no definitive leads, we weren't expecting a lot from today's trading session. I think heading into the session, we were calling the market up maybe 10 points or 0.2%, looking for it to unwind around that 44.07 level. Now, just looking down at my screen, we're a little bit stronger than that, which is pleasing, up about 0.3% around that 44.10 level. We are seeing a bit of money returning to some of those major miners. You've got BHP up 0.1, Rio up 0.9. Fortescue continues to amaze, up 2.5%. It's hard to believe that just a couple of days ago people were, talking, very prematurely, in my opinion, about the demise of Andrew Forrest's iron ore empire, and people were really preparing themselves for further downside risk. But he did manage to restructure his debt financial package, and the market's loved it ever since. And that stock's up a further 2.6% today. So it's really those major miners that seem to be putting a couple of points into the market today. Also note the energy sector's up about 0.8%. We did see crude prices rebounding a little bit last night. Of course, they have been under heavy selling pressure in recent days, with the Saudis announcing that they're going to increase production. But we did see crude oil prices rise about 1.6% last night, so a little bit of stability there. And some of those names like Woodside up 1.8%, benefiting from that higher crude price. But like you said, it is a Friday. We don't have hugely definitive leads today. There's probably no real reason to chase this market too much higher today, and I'd expect it to just maybe trade around these levels for the remainder of the session.
Cam, are you taking any comfort at all in the fact that US stocks, generally speaking, ended the session fairly steady in light of this manufacturing data globally that's come out?
Look, the thing about the US market at the moment is it's got that backstop, and I think I spoke about this morning to a couple of journalists that we had some fairly weak economic data out of the US last night. We had jobless claims falling, but the 4-week moving average rising. We had leading indicators being fairly weak. We had the Philly Fed manufacturing index contracting for a 5th consecutive month. We had again continually weak PMI numbers out of Europe. But I think the market in normal instances and circumstances would probably sell off on that, but there's this implied backstop now. We've got the ECB bond buying program, we've had the Fed announce QE, so I think that's acting as a bit of a backstop to stocks, and that's probably why markets haven't traded off as they probably would have had these programs not been in place.
So is there a bit of a hangover effect now from the big Christmas New Year delivery, I guess, by way of that bond buying program by the ECB and the Fed's QE3?
Yeah, look, I think the market seems fairly evenly divided as to whether this rally continues into the end of the year, or whether or not we're due for a 5 to 8% pullback. I've read equal amounts of verbiage arguing both sides of that story.
What do you think then?
Look, I honestly don't have an opinion at the moment. I'm pretty neutral on the market at the moment. I think there's scope for either way. I think we could maybe see a little bit of a pullback and then a bit of a rally into year end. But there's a couple of crucial event risks at the end of the or coming up. In 6 weeks, we've got the US presidential elections, and then of course we've got that looming fiscal cliff by the end of the year. So depending on, I think they're going to be the two dominant stories that influence this market over the remainder of the year. So depending on how they play out, that will really dictate people's views on the equity markets. But if the president elections go in Obama's favour, I think that's going to keep the market relatively steady. A lot of people on Wall Street are obviously cheering for Romney because he's got that sort of pro-business stance, and Wall Street certainly seems to be behind him. But I think the fiscal cliff's going to be the big issue at the end of the year, and depending on how quickly Congress can get themselves in order after the presidential elections will really determine whether or not we see that Santa Claus rally or not.
So is it now a consolidation phase of the market? I mean, where to next? I mean, you won't really make a call on where you think our local market's going, but generally speaking, on the global market, that bigger picture, where to next?
Look, I think, we are in a consolidation phase. I mean, I think, the point for me, which markets have probably been in this bit of an uptrend, was, several weeks ago when Mario Draghi came out and made his, now infamous whatever it takes line. Markets have had raised expectations from the ECB since then, and the ECB have delivered. We had a nice run up over the last 2 or 3 weeks in particular in the lead up to that German Constitutional Court vote, and then the FOMC decision last Friday. That's all been delivered upon now, so we haven't really seen that buy the rumour, sell the fact. It's really just been buy the rumour and now sit and wait, and we haven't seen that pullback that some people are expecting. So I'd expect markets to maybe just consolidate around these levels, take their guidance from how effectively some of these stimulus programs can be implemented, and we'll really just sort of idle into the presidential elections, and then once that's out of the way, then they can make an assessment on how they see this fiscal cliff issue playing out.
Short term though, and certainly speaking in terms of Europe and those Spanish bonds, and out of sympathy the Italian bonds as well, it seems that for the moment at least the prevailing gloom isn't in sight or worrying those buyers of those bonds.
Yeah, no, that's right. I think the disaster scenario has been taken off the table with Europe now. People seem a lot more relaxed about it. Spanish yields are up 5 or 6% one day, down 5 or 6% the next day. I think everyone, would like to see those yields be pushed a little bit higher to force Spain to ask the EU for bailout assistance and sort of make them, I guess, eligible under that ECB bond buying program. So, but all in all, I think people are a lot more comfortable with the situation now that the ECB has finally got involved, and there's not this sort of antagonism amongst all the member states of the euro, which there was, over the last 18 months. They do seem to be more on the same page now, and working closer together, because I think they've realised the gravity of the situation, and we can't go on indefinitely just year after year bouncing around trying to solve these issues. I think they realise it is coming to a head, and they need to work together to come up with a solution.
Yeah, absolutely. All right, Cameron Peacock, IG Markets, thanks so much.
Thanks, Maura.